would like to talk about an asset allocation indicator. This is a chart of the bond yield versus the stock yield. Now the bond yield is the coupon divided by the price, and so on the one hand you get the bond yield, and on the other hand we have the stock yield, which is a little bit more complicated. That is the S&P 500. So we take the PE of the S&P 500, and then we have 1 divided by the PE of the S&P 500 is the stock yield. And the bond yield is for the 10-year US Treasuries. Now, as you can see there, this is, by the way, a chart over the last 50 years. It tends to stay for quite a period of long time below or above the mean, and which is right in the middle. And when it's above here in the green area, then stocks are cheaper than bonds, and when it's below in the red area, then bonds are cheaper than stocks. But what you can quickly see right away is that this can stay that way for a very long period of time. Now, interesting is, however, one thing: when we get into these spikes up here or down here, which means that the yield differential between stocks and bonds is 3% or higher. Up here it was 6%. Down here it was close to 6%. So up here more than 6%. So they can get quite large, the yield differentials. And the interesting thing is this: when we get to these spikes, that then immediately on the backside of these spikes, it seems to revert back to the mean fairly quickly. And we can see this in several cases here. In almost all cases, it comes back fairly rapidly. So this indicator is more important to us in the sense that we know once we've seen a spike that we then tend to go fairly quickly back in the other direction. And right now, of course, the interesting thing is we're just coming back. We're now at the beginning of 2011 from this spike, and we're right here at the moment. And we would expect for us to come back at least to back down here. So that means that stocks would at least have to go sideways, possibly out, have a positive rally, and bonds at the same time would continue to sell off, so that that we would cover this area down here to about here. And that's a pretty good indicator once you see these spikes for asset allocation, because right now you would not want to invest in bonds, but you could still stay long in stocks even though they've had already quite a good rally. So it's a pretty useful indicator for longer time periods and for asset allocation.